Now we're looking at the same exact chart and stuff like that. So we got that out the way now. So now we can actually get into what do we actually look at. And I have broken down in a video. It's in the advanced folder. You can go watch this after this one-on-one session, but it's in the advanced folder, and it's the when to buy set of videos. So I have a when to enter a trade, and then I have a when to enter a trade for a buy and a when to enter a trade for a sell. So I'll tell you how to start from the beginning of looking at your chart all the way to when to enter a trade for a buy and a sell and what you should look for. But we have, about the support and resistance. And then we have like a trend line, which is basically the direction of our market. Then we have our supply and demand, which is basically like a zone to enter a trade or look for the market to enter into to see if you want to enter a trade. So we have all of these different things, right? Every indicator or confirmation to enter a trade. But I do understand that the hard part is when to or how to put it all together. So the way that I do it, I like to start from the simplest of things, which is support and resistance. So your floor and your roof of the market. So think of it as like two tennis players playing in a match, right? And the candlestick is our ball just bouncing back and forth between the two opponents. And then eventually, one of the opponents lose and the ball continues to go past them, and the other opponent wins, right? Right. So that's how I think of this. So let's go over. I'm gonna go over this part of it right here. All right. So we have our floor and our roof right here. So I'm gonna put a support for our floor, and the support colors are usually coordinated with green and blue in most scenarios, because your support, you want to use that for buys. So whenever you're looking at your support line, you want to see if it's giving you a buy confirmation in a way. Like you want to see if you could buy around that area. And then whenever you are looking at a resistance, which is your roof, and the color coordinated with that is usually red in most cases. So when it gets to this area, you want to see like, okay, can I sell around this area? Do I have any confirmations for me to sell if it gets to this point or anything like that? So we now have our support and our resistance, which is this green line and this red line. And the candlesticks, these small little rectangles in between, think of it as like our tennis ball, bouncing in between the red and the green line, our two opponents in this situation, right? You're starting to see it, like it's basically like a ball just bouncing in between. So that's how
I never thought of looking at it like that. Okay.
Yeah, like it basically makes it very simple to see the two opponents. So another way to look at this is, I know you probably heard me mention the slang term or mention the terms bulls and bears.
Yeah.
So bulls, think of how they attack, right? They attack with their horns, and they usually knock things up, right? With their horns. They try to knock things off their feet using their horns. So think of the direction that they are attacking in, up. So that's why we call a buying market or a market that's moving up a bullish market. And then when bears attack, they attack down with their paws. They're clawing everything down or smacking things down with their paws or their claws. And that's why we call a selling market or a market moving down a bearish market. So whenever you hear those terms, basically think of how they attack and look at the market and see which direction it is going in. If it's going up, it is a bullish market. If it is going down, it is a bearish market.
Okay.
Back to basically the candlesticks and trying to read them. So we now have our two opponents, right? We have figured out where our support is and we figured out where our resistance is. Now, the way that you know where your support is, you want to look for quick changes of direction that causes the market to go up.
Quick change.
So let me zoom back out real quick. So you want to look at scenarios where the market is like in a strong downtrend, and all of a sudden you see that the market pushes up. So you can walk through this with me. We're going to start from, well, I'm about to clear my whole chart so we can start from the very beginning. So,
okay,
let's say here. So we see that the market is going down on November the 5th of 2021. You see that the market is going down, or you can just look at my chart for this right here. And if you want to follow along, you definitely can on yours. But you see that here that the market is going down, right? It's selling down tremendously. But then all of a sudden, right here at this point, we see that the market buys back up.
Okay.
So that tells me, okay, maybe I need to watch for this area, right? You know, it may be some buyers around this area that caused this market to quickly change in direction because it was selling down for a couple of hours, it looked like. And then all of a sudden it started buying up. So that's how I know that that is a level of support. Let's look at before then. The market was buying up a lot way before then, like a whole lot. Then it finally got up to a peak. And now that we see a continuous sell-off of candles. So now, since it has reached its peak, the market is selling off a lot. It sold off consecutively for like 1, 2, 3, 4, 5, 6, 7, about 8 candles. So it sold all the way down for like 8 candles. So that tells me, okay, that was a very strong level of resistance, right?
Right.
So that is one level of support and resistance. And you can have a lot of levels. Like you can have different levels. Me personally, whenever I'm looking at a concentrated area, like a specific area, I want to see if I can find at least 1 or 2 supports or 1 or 2 resistance areas. So we have one. So now back to where the market changed in direction to go up for the buy. It went back up. Then boom, it got back up to this resistance area, right? It got back up to this red line. And what happened? It sold back down. So when it hit that red line again, or our resistance area, it sold back down. So that confirms that this is a very strong resistance, right?
Right.
When it enters this area of the market, then sellers are in that area ready to push their market back down. All right, so now that it pushed the market back down, we're looking for it to come back down to this green line and see if it's going to buy back up again. But we see that it stopped just a little bit short, right? It stopped just a little bit short and it pushed back up. So since it stopped a little bit short and it pushed back up, that lets me know that, okay, this may not be a specific buying point, but this could be a buying area.
Yeah. Okay.
So that's where your supply and demand zones come in at. So your support and resistance lines give you a specific point, but your supply and demand zones give you a specific area to buy in. Do that make sense?
So the zones are more, I guess in this case, more defined. Like that's a more defined area of when you gonna actually start entering a trade.
Yes, in a way. So it's like instead of looking at a specific price, like let's look at our green lines on my screen. So my first green line is at the price of 4,686. You see that? So it's at 4,686. And then my other support line is at 4,689.
Okay.
So instead of looking for price to come back down to that exact price of 4,686 or 4,689, then I'm more so looking at a zone in between those two prices to buy in. So as long as it's in between their range of 4,686 to 4,689, then that's a good buy zone because I know that there are buyers within those two prices.
Yeah.
That makes sense?
Mm-hmm.
So in between those two prices, it creates a zone for you to buy at rather than a specific price point. Because we see here that the market did not come back down to 4,686, right? We were looking for it to come back down to that specific price. But since it didn't, then we possibly could have missed out on a good trade because we're looking down for it to come down to a specific price. Whereas if we had a zone, well, I know that if it enters this zone, it's still a good trade to enter for a buy or a sell because there are buyers in this area or there are sellers in this area. So
zone triggers.
You said what?
A zone, like kind of like a trigger.
Mm-hmm. So it's basically like, what's another way I can put this? Trying to think of more examples to where this could be simpler, really. Trying to think of like sports or something. But I don't know, I can't think of none right now. If it comes to my mind, I'll definitely let you know. So that creates a zone for this area where I just put in this square box basically. So I put a whole green box to represent a zone more so than specific price points. And then I'm gonna get into how to mark up supply and demand zones a little bit later on as well. But I was just kind of introducing that idea that instead of looking for certain prices to enter a trade, you can also look for zones, which gives you a wider range to enter a trade in. And you don't have to try to wait for, oh my God, it got to come to this specific price in order for me to enter this trade. But it could come short or it could go further than that price. So you never know. Now, let's get into a supply zone, which is your resistance. So your supply zone works the same way as your resistance, just like your demand zone works the same way as your support. So think of it as when something is in high demand, a lot of people want to buy it, right? When it's in high demand, everybody want to buy it. They want to get a piece of it. But when there's high supply, then, there's really no need for it. It's always going to be there. So you don't have to really be in a rush to buy it because it's always going to be there. Mm-hmm. So people are more than likely to sell it away or sell it off or just let it be. You know what I'm saying? So that is why we call it the supply zone. And it's really a deeper meaning to that, but to make it simpler, I like to put it in a way of like the economy. The demand for something, people are going to buy more. If there's more supply, then people are probably going to sell it off more. Yeah. So that's where I get my supply and demand from. So back to it, support and resistance give you specific price points to where to enter a trade. And then your supply and demand give you a wider zone for you to look to enter a trade. All right. So back to our tennis match. They were going back and forth. And then we see that we finally have a winner here. And our winner is the red zone, or basically our sellers. So our sellers ended up winning because the ball, which are the candlesticks, finally went through our green zone. It went past our green line. So that's how I know that the sellers won overall. If the market was to go through our red line, then that would tell me that the buyers won overall.
Mm-hmm.
So zoom back into this case. So we have our green lines, we have our demand zone, and we see that we have a very large candle breaking through our green lines in our green zone. Now, what really confirms it is what happens after it breaks through. So after it broke through, we see that the candlesticks did not come back above our green lines, right? It stayed below them.
Mm-hmm.
So since it stayed below it, it tells me, okay, sellers are still in control and that this market is going to continue to go down. So now we know who is in control of the market. Another way that you can tell is by the trend. So now let's get into trend lines. So we were kind of already seeing that sellers were in control of the market before it even broke through our green line. How is that? Because of the higher or lower highs. So we had lower high points. You see that we had a very high point right here. And then as it continued on, it created a lower high point. And then as it continued on, it created another lower high point. All right. Mm-hmm. It wasn't like the market was going like this. I'm about to draw it up. It's not like the market was going like this. Boom, 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 boom. Right? It's not like the market was creating higher highs and also higher lows. So here we have a higher high and a higher low. How do I know that? Because this peak is higher than my previous high peak before. And then this low peak is higher than this previous low peak. So this is telling me that the market is in a continuation of going up. You see that?
So these are like kind of given, like from the way I'm looking at it, it's kind of like foretelling there's gonna be an eventual like dip or a sell-off in that point.
Yep. Yep. That's exactly what it's giving you. Like it's telling you what direction the market wants to go in. So like let's say, and you could do this on your chart as well. You see how I just drew up lines?
Mm-hmm.
Well, you could make your chart into a line chart and see it even clearer. So let's turn this into a line chart. You see what's still going on? And you could do this by going up. So right there by how you change the time frame, like how you change it from a daily to 1 hour. Right there beside it, you could change your candlesticks to a line. So you'll click on the down arrow and then you'll see line. And you can click on that and it'll change it into a line chart. So you can see it even clearer with the lines that the market is trying to sell off, right? It's creating lower highs. So we have a high peak right here, and then our next high peak was here, but it is lower than our previous high peak. Okay, let's look again. Where is our next high peak at? It's right here after a dip. So after a dip, it came back up, and then it created another high peak, but is lower than our previous one. And then it sold off. So that's how we knew that the market wanted to sell off before it even did so. So same thing when the market is buying up. So here we see that the market is creating higher lows, right? So right here where my green line is going to go, we have our low, which we call it swing lows and swing highs. So here we have our swing low. And when we say swing low, we basically mean like the lowest point that the market has come to within that time frame that you were trading. So let's say we were just watching this move happen. Here, let's rewind. Let's go all the way back. So like, let's say we're looking at the charts right here in this moment, right? Then our swing low would be right here, because this is the previous low point that the market had that caused it to buy back up.
Okay.
Or the previous low point that we had before the market decided to buy back up. So let's play it forward. Boom. We create another low point. So here, the market has now created another swing low. But where is this low point? It comes right here. So it comes to right here. But we see that it is higher than this one. Right? Yep. So that is a higher low. Exactly. So I'm kind of getting a direction of where the market wants to go now. Right? We're kind of seeing, okay, this market looks like it wants to buy up. Let's see what happens next. It comes back down to that previous low point. So let's see if it goes lower. Nope. It did not go lower or break below that swing low. So that tells me that the market is still in an uptrend. So unless it goes below the previous swing low, if we're looking for a buy, so we're going to talk about in the case of uptrend. Unless the market breaks below the previous swing low or low peak, then that market is still in an uptrend. And then vice versa. If you're in a downtrend, unless the market breaks above the previous high peak or swing high, then the market is still in a downtrend.
Okay. I'm gonna have to see the swing high.
Yeah, so the swing high is back to this one right here. So we have a high point. And then it creates another high point or a swing high, but it is lower than our previous high point. So
that's what you abbreviated SL earlier.
When I added that video, I was talking about stop loss in that video, but SL is sometimes used for swing low and SH is used for swing high. So that's another, you definitely want to be careful on which terms you're using, but SL is mainly used for stop loss. So I usually don't speak on swing lows. I'll just say the lowest peak or highest peak. But I was just letting you know, like, that's another term that some people do use whenever they're speaking on low peaks or low points and high points. But yeah, but this is like these are two great examples of a downtrend and an uptrend, and how to point out high points and low points and higher lows, higher highs, and lower highs and lower lows. So now that we have a sense of direction for our trend, and like I said, if you want to, see it in another view, you can always switch it to a line chart, but they're still representing the same things. One is just a line and one is just candlesticks.
Which do you prefer?
I prefer candlesticks mainly because it gives me a better indication of the market and seeing how it's reacting. So with candlesticks, which I'm going to get into candlestick analysis later on, like that's deeper into it. But candlestick analysis allows you to see a move way before it really takes place, honestly. So just off reading candles, you can also get an indication of where the market may move to. So these are the three main things that I look for whenever I'm about to mark up a trade. I look for sense of direction. So what direction is the market going in? Is it going up or down in the current moment? Or is it going side to side? You see a lot of cases where the market is basically just going side to side. So it's not really going up or down, like in this situation right here. Before it finally broke through, the market was kind of just going side to side, right? It wasn't like, even though we know now that it's in a downtrend, it was creating lower highs. For the most part, it was just moving side to side, almost like a snake, just going up and down. And then it finally broke through and it continued to sail down. So what I mean by sense of direction is you could clearly see that the market is selling down. Or even better example is right here. So in this market, it's just going side to side, right? It's not really going up or down. It's just moving side to side. And then we finally got the breakthrough that caused it to buy up all the way up to here again.
So if you accidentally or unknowingly you took a trade in that area you were talking about, would the best bet just be waiting it out and just
come on, if you took a trade in consolidation?
Yeah, consolidation, that's what's called.
So if I was to take a trade in consolidation, what you would want to see is how big is your range of consolidation from two different prices. So let's say I enter a trade in consolidation up here. We see our red line and our green line is far apart, right? It's a little far apart from each other. So that's a very big zone for me to just wait it out in. That means if it was to break through this red line and continue buying up, we're going to lose a lot of money. You're already going to be in a big drawback if you're waiting in this range as it is. So once you see how big your zone is or how big your range is, then that lets you know if you could wait it out or not. So if I was to enter a range of consolidation right here, like let's say I entered way too early and it's still a consolidation in this range, okay, then I'll wait this out.
Yeah.
I'll wait this out right here. I got my red line right here. So I have my red line and my green line. This is a small range, this is not much, honestly. But I will put my stop loss very, very, very tight. So I would put my stop loss, I'm gonna make it a black line. I will probably put my stop loss a little bit outside of the zone like this, outside of my red line. So therefore, if it does break through, then I know that it's going to continue to buy up. But honestly, I wouldn't even enter a trade in consolidation. I will wait till I have a clear sense of direction before I enter the trade. That was if I did enter too early. a trade is always going to retest, and we're going to get into that as well. I'm gonna send out another link right after this one expires, but I'm gonna tell you about like how to enter off a retest and how to exit off of a retest and stuff like that. But yeah, I just would try to avoid at any cost not entering a trade during consolidation. And you will usually know when a trade is about to enter consolidation because it's not going to give you any sense of direction in the market. Like it's not going to let you know if it's really going up or down. And also, you always want to trade off of a break of structure or clear indication that your trades are going to continue to buy up. So,
Okay.
you always want to make sure you have your confirmations right before you enter a trade. And usually in consolidation, you do not have your confirmation because most of the time it's a choppy market and it's not giving you anything to go off of for you to enter that trade for a buy or a sell. So it really, the way that I teach the trade, it really takes that out of like the equation on entering a trade going off of consolidation and stuff. But we now have our support and resistance, and you can mark it up for different areas. Like here, we have what was a support zone, and you see even here, it was our support up here, right? But it became our roof once it broke through. So we know that the market doesn't just move in straight lines, right? It doesn't just go straight up or straight down.
No.
That was the case with all we millionaires right now. But it moves in waves almost. So it goes up, it comes back down. It may go higher than it did before, or it may go lower than it did before. It moves in waves. So your support can always become your resistance, and your resistance can become your support. And many different examples of that is like shown just in this little market space right here. So here, like I said, it was our support and then it broke through. Now it became our resistance. So I can make this line red now. And now this is my new support line. This is my new support and this is my new resistance. Does that make sense?
Yeah.
So now we have a new floor and a new roof. And we have two new players going against each other. So now we got to do the same thing that we did up here, right here in this area. So we're going to pick up right there in this next Zoom link going based off of this zone right here. All right, so now picking back up from where we left off, which is our new zone that we are trading in now, it's basically the same exact way. So let's zoom into it. And now we have a new market that we are looking at. So we have our two opponents now, the red line and the green line. How did I set my green line again? Because the market was in a downtrend and then it quickly changed in direction, making it go up. Same thing with the downtrend, or same thing with the red line. It was going up and then it quickly changed the direction and sold back down. So I usually like to set my support lines and my resistance lines at the wicks, which are these red lines and blue lines coming out of the candlesticks. You know what we call wicks. So I usually like to set mine at the end of the wicks because it really give me a clearer or a better indication of where could the market possibly go to. So,
Okay.
Yeah. So the wicks, it lets me know where the market could possibly go to. Because it has went there far before. Now, although price didn't close or open at that level, it went to that price. So it lets me know that it could go there again. to fill in those wicks.
Okay.
So whenever we talk about filling a wick in, that's what we mean by that. So that means like we expect the market to go back in and create a candlestick where this wick is. So here in this example right here, we have our 2 wicks, right? Coming out of these 2 candles.
Mm-hmm.
And then let me make it clearer or better. I don't know why my laptop is going so slow right now. Anyway, we have this wick, right, in this candlestick. And then we have this candle actually coming in and filling that wick in right here. So instead of this being empty space in a wick, we now have a full body candle filling all of that empty space in that it created on these 2 wicks right here to the side. Does that make sense? Well,
So is it like for sure it's gonna fill in there, like where the wick is?
I would say this. It's not really a matter of if, it's more so a matter of when. Because in most cases, it do come back in and fill in those wicks. It may not do it on the very next candle or even the candle after that, but it could do it later on in the market. And that's the same way with a lot of things when trading, honestly. That's why we always react to the market instead of predict it. Because if you react to it, then you don't have to worry about it filling in those wicks. You're more so just going to wait for it to do it. Instead of thinking, oh, it wicked out on this candle, so the next candle is going to fill it back in. When truth be told, most cases it does not. Sometimes it just continue to sell on or buy off, and it doesn't come back and fill in that wick until like later on. So I always react to it instead of predicting it. But that's why I like to put my support lines and my resistance lines at the end of a wick, because it gives me an idea of where the market could possibly come back to. And I look for it to come back to those areas either very soon or later on in the market. So that's why I put my lines right there. Now, again, we have our 2 opponents, our resistance and our support going back and forth, bouncing this ball in between or hitting this ball back and forth in between both of them. And then we see right here, the red team won again and knocked the ball through the green line. You see that?
Mm-hmm.
So it knocked the ball through the green line. And I don't consider it a knock through unless we have our candlestick, a full body candlestick, going through the red or the green line and then closing in another candlestick below. So in this candlestick, this confirmed that the red team won. Why? Because we have a full body candlestick.
And those are the sellers.
Huh?
And those are the sellers.
Yep. These are the sellers right here. So we have a full body candlestick instead of just wicks going through the line.
Okay.
You see the difference?
Yeah, the candlestick kind of like, no. The wick, like you said, it was kind of like an indication. And then the full body candle is the confirmation.
Yep. The full body candle is the confirmation. So this is my confirmation right here that the sellers won. This big body candlestick right here was my confirmation that the sellers won.
Bless you.
thing. And then what made it even more of a confirmation was the candlestick that came after it. What we get again, we got another big body candlestick right after it, which is what you usually want to see. You usually want to see two big body candlesticks back to back to confirm a break and close of structure. So this will be your break. That first candlestick will be your break. And then your second candlestick will be your close. And the reason you want to wait for a break and a close is because sometimes you will get a fake out. So you will get a break like this, and then you could get a candle right afterwards, and it'd be a buying candle buying this all the way back up into this zone that we was in before.
Yeah.
So you may think that it's going to sell down, and you enter the trade too early, and then it buys all the way back up from where it sold off, and now you are out of profit because you thought it was going to sell off and you entered too early, but it was just a fake out. So that's why it's very important to wait for the break and the close.
Gotcha.
So we have now pointed out that this market is still in a downtrend even after the first break, and then we got the second break confirming that this is still in a downtrend. Now, back to what I was referencing earlier with the support becoming your resistance and your resistance becoming your support, you see that again right here. So over here, it was our support, right? Then once it broke through, it came back and retested, and now it's our resistance. So we can now make this green line red. You see that?
And that's the new.
Yep, that's our new roof now. And now we have a new floor right here. So now we're back playing this game again. We're now back in a tennis match. So now they're going back and forth. And while we're in this tennis match, we see here that we have a swing low. And then back to our higher lows. Remember we were pointing those out earlier? We have higher lows now. So you see how it's kind of hinting off that it's one to buy back up.
Yeah. Mm-hmm.
Even if we switch it to the line chart. You see, we got our lowest peak, and then our next low peak is right here. It's higher than our previous low peak. Okay, let me write that down. Let me note that this may continue in an uptrend. Then we get another low peak, but this low peak is higher than both of our previous low peaks. Okay, this is definitely wanting to move up now. So once we get that confirmation, we get 3. I like to play by a rule of 3. After 3 new higher lows or 3 new lower highs, then that's a confirmation that that market is wanting to sell down or buy up. So 3 consecutive higher lows, the market could potentially buy up. 3 consecutive higher highs, 3 consecutive lower highs, then the market could potentially sell down.
Right.
You want me to repeat that again?
Yeah, just one more time.
Are you good? So after 3 consecutive higher lows, the market could potentially buy up. And after 3 consecutive lower highs, the market could potentially sell down.
Okay, appreciate it.
No problem. The way that you will confirm that is by the break of structures. So we'll get into that in a little bit. but I kind of just want to point out like the basics of spotting higher lows and higher highs and spotting your resistance and support and how to find direction of the market. So we see here that the green team won this time, right? Because it broke through our red line. It broke through our red line, and then that's what started to buy up. You see that?
Yeah, I'm with you.
So now we get to a new level. So after it won down here, we get to this area over here. And I like this because a lot of the times your old support or old resistance, not only can it switch and your resistance can become a support and your support can become a resistance, but they can also be reused in the future. So if you had a support a long time ago in another area, later on, it could come back to that same area and still treat it as a support, and vice versa with the resistance.
Right.
Because you see here that, let me get rid of some of this so we can clear our screens. Well, I can really start brand new, but we see here, right, that we had our resistance a long time ago. This was all the way November the 5th. So on November the 5th, the market, this was our resistance over here on November the 5th. Then we come all the way to November 16th, and it came back to that resistance area and it bounced off of it again. So it was our resistance on November the 5th and November 16th because it came back to that level and still rejected it and treated it as a resistance. That makes sense?
Nobody would realistically, nobody would be in a trade for that long, right? Like that's just.
No.
Okay, I made
yeah, like some people could hold trades for like days to a week. Some people may hold trades for a couple weeks, but rarely you see people hold trades for like 2 weeks to a month, honestly. Unless they're in a big swing trade and they're like expecting price to go back down to a certain level. But that's in a matter of trading as if you know, rather than let me trade and just let me catch a couple pips. You know, it could go lower, but I'm gonna just get my money and get out the market. You know what I'm saying?
Yeah. Definitely.
Rather than trading like, okay, I know that when it gets to this point, it's gonna sell all the way back down here, or if it gets this low, and I know it's gonna buy all the way back up there. So that's something that like really big swing traders do, but people usually don't hold their trades for that long. And swing traders are basically people who hold trades for longer than a day. So you have swing traders who hold trades for longer than a day. You have intraday traders, which go by day traders as well. They hold trades for no longer than a day. So they only hold trades to like the end of the day and get the pips that they collect out of that day. And then you have scalpers who really trade in like 15-minute time frames. So they only may hold a trade for like 15 minutes or an hour or something like that. They don't hold it for all day, but they hold it for like a certain period of time to where they get the amount of pips that they want to get and get out the market. Sometimes they may only hold it for like a couple of seconds or 3 minutes or something like that. So those are the different versions of traders. So a swing trader will probably hold this trade that long. Now, a smart swing trader probably would have collected their profits once it got down to this low point. Hopefully, nobody held their trade this long because they missed out on a lot of money right now. This is a lot of money, right? Like we're looking at just lines right now. But if I was to, let's measure this out. Let's see how long this really is. So just from the top of that peak down to the bottom right here, that is about 74 pips in the market. No, it's 745 pips. So at the most, well, I'm not going to say at the most because somebody probably could have made millions off of that one trade right there. Let's say at the least you're making $745.
So wait, so so pips and dollars are pretty much the same thing, or?
Yeah, pips. Now, pips, think of it like steps in the market. You know, everyday life, we take steps up and down, right? We take steps forward and backwards. So pips are basically like your steps in the market. A pip up, you're taking a step up in the market. A pip down, you're taking a step backwards in the market or taking a step down in the market. So pips is basically like steps going up or down in the market. 2 steps forward, 1 step back, 2 steps forward, 1 step back. Overall, you're going up, but you may have a little step back as you're going up. You get what I'm saying? And vice versa whenever you're in a downtrend. So you can correlate pips to money by a certain formula, which is your lot size times the number of pips would give you the amount of money that you're risking or able to make from that trade. And I made a video on that as well. But
yeah, I got my notes from that somewhere around.
Yeah, so like your pips is basically like a step in the market. But that's just an example of like an old resistance can be used again. And same thing with an old support. So, oh wait, no, let me turn that back off. All right.